managing Australian fixed income exposure is increasingly difficult. Portfolios are tightly benchmarked, capital flows are uneven, and replicating index performance can be a challenge. This creates a need for better tools to manage exposure, risk, and liquidity in the Australian market. Thank you for joining us today. Today, we are taking you through an exciting initiative in Australia's financial markets, being the upcoming launch of ASX and Bloomberg bond and credit index futures contracts. These products leverage ASX's position as the world's fourth largest interest rate derivatives market globally. We are the largest in the Asia-Pacific region, and we provide deep access to futures liquidity across a global customer base. Joining me today is Marco Bachmann, co-head of Challenger Investment Solutions, and Nita Kong, product manager of rates at ASX, who is leading the initiative to bring these products to market.
I appreciate the opportunity to talk about Challenger Investment Solutions and how we work with clients in fixed income. Our client base includes superannuation funds, insurance companies, family offices, and wealth platforms, each with their own regulatory, operational, and investment governance constraints. So flexibility and a broad set of tools in the toolkit is key to managing that effectively. In fixed income, we've got access and we utilize a set of different instruments, including bonds, futures, interest rate swaps, CDS, and total return swaps.
ASX is targeting the launch of 2 new futures contracts. The first one is over the Bloomberg AusBond Composite Index, and we have another one over the Bloomberg AusBond Credit Index. And through our partnership with Bloomberg, we are developing exchange-listed contracts that are linked to 2 of Australia's most widely recognised fixed income benchmarks, already deeply embedded in the Australian market through portfolio construction and performance measurement across the market. And just to frame it a bit further, these 2 indices underpin a large portion of the market already, with about $58 billion in funds tracking the composite index and about $2.5 billion tracking the credit index. So with the evolving market conditions that we have been seeing as of late, investment managers are looking for more precise tools that will help them with effectively managing their exposures to these indices. Interest from managers benchmarked to these indices include, for example, superannuation funds, where APRA references these indices under the Your Future, Your Super mandate, as well as ETF issuers, where we're seeing the growth of fixed income ETFs. So with these future contracts, both the composite and the credit indices provides practical tools for investment managers to implement and manage their exposures accordingly. And then overall, these tools will definitely expand ASX's fixed income toolkit. And for the first time, we are bringing a credit index that is centrally cleared and exchange listed to the Australian market.
Let's split it into kind of how our clients would use it or could use it, and also the impact it may have on the broader ecosystem in the Australian fixed income space. So we see kind of 3 use cases for clients. The first would be passive exposure, generating passive exposure or enhanced passive. So that involves using the cash to generate an attractive cash return, say cash plus 30 basis points, and using the derivative instrument to get index exposure, which together generates a portfolio that is the index exposure plus a small outperformance over the index with virtually close to 0 tracking error. The second use case would be exposure management. So that would be, for example, a fund wanting to rebalance from Australian equities to Australian fixed interest. And rather than doing that physically, they could simply sell the ASX 200 SPY futures and buy the AusBond Composite Index futures to achieve the same outcome with simply 2 transactions. And then finally, it's what we would call bridging exposure. So it involves keeping the exposure, for example, between the time of changing managers from an old manager to a new manager, or the time when new cash comes into the fund and before it gets deployed into physical assets. All of these are cases, what I would describe as beta use cases. So there'll be, in addition to the real money investors, there'll be other beta style investors like ETF providers, index funds, maybe even active managers, all of which track the benchmark and at times will have a need to synthetically replicate the benchmark. And at the moment, what they would have to do that is trading a combination of bond futures, interest rate swaps, and CDS to replicate and proxy the index as closely as they can. Now, putting that into perspective, if that was in equities, it'd be similar to not having a SPY futures contract and giving everyone futures on BHP, CBA, Wesfarmers, and Telstra to replicate the ASX 200, which clearly is less effective and more effort than just trading SPY futures contracts. On the other side of, which is what I would call alpha investors, so that may include, again, sort of active investors, but also relative value managers or even bank treasuries. That type of investors are actually looking at the relative valuation of each of the 800 bonds in the index and decide which one to go long or short to generate alpha, or which part of the curve has the highest carry, and therefore invest in that. And for those investors, having an index future may be attractive as well as one more instrument to generate alpha from. Again, the equity equivalent would be index arbitrage, and I'm sure that a lot of relative value managers in the fixed income space could do something similar. Finally, to put the size into perspective, if you add up the amounts outstanding on the AusBond Composite Index, it adds up to 1.7 trillion, which is roughly half the size of the ASX 200 market cap. So it's definitely a huge pool of assets. And as you said, a lot of index products are linked to the index. And also we looked at the APRA data for regulated super funds. About 600 billion out of the 3.2 trillion of regulated super assets is allocated to Australian fixed income, which is benchmarked to one of the Bloomberg AusBond Composite Indices. I think you definitely chose one of the indices that has a lot of eyes on them for the launch.
When ASX thinks about new products, the design is critical, as you've mentioned, particularly for us with a focus on liquidity and activity from day one. So firstly, from a contract design perspective, these futures have been developed with a lot of market input, as well as an emphasis on international alignment. This helps them be straightforward to trade and easier to integrate into existing systems and workflows. Now, for key design features that we've considered, that includes quarterly expiries and cash settlement, so sort of like the ASX 24 bond futures now. And we'll also have block trading with low thresholds, and that's to support early open interest development. And finally, most importantly as well, ASX is actively engaging with market makers and liquidity providers to support strong on-screen liquidity as well as block liquidity from launch. And that approach sort of helps the markets access transparent and tradable markets from day one.
There are definitely a number of key areas of differentiation between the futures and other alternatives. Firstly, it's worthwhile pointing out that to getting bond index, synthetic bond index exposure at the moment, total return swaps are really the only other alternative. So that's an OTC instrument. So the first comparison point would be the operational setup between sort of the listed futures contract and an OTC instrument, where all of our clients have access to futures, and generally even their peers outside of our client base would be set up for futures by default, whereas getting access to OTC products requires this with multiple counterparties to create a panel of banks. Even the cleared OTC setup is generally more involved than the cleared futures setup. So it's definitely easier to set up from an operational perspective. Secondly, in terms of the margin usage and capital efficiency, futures are standardized instruments. It's transparent. The initial margin is published on the website. It's the same margin regardless of whether you're a small fund, a big fund, a levered fund, an unlevered fund. So it's quite nice from that perspective. Again, on the OTC side, there's a wide range of different rules around initial margin. So it ranges anywhere from regulatory initial margin to potentially no initial margin, or quite punitive if you're a small or levered fund. So it can be better, but it's definitely more transparent. And finally, in terms of the execution, this is one where I think probably more similar in terms of the execution than most people would assume. And what I mean by that is that transacting, say, the total return swap on the bond index is more or less the same process as doing a block trade on the index futures contract, in that you would go out to a panel of banks, ask for the prices, transact with the best price. And the main difference is the delivery of the risk, where in the futures contracts, the risk is delivered via the exchange traded listed contract rather than a bilateral TRS. And we've seen multiple times that block trading in a lot of other futures contracts can be a way of executing large volumes of trades, even if the order book looks less active. It doesn't mean that you can't execute the trades. So all in all, the 2 new futures contracts are definitely a good addition to the ASX toolkits.
I'll start with the timeline. ASX is targeting a Q3 2026 go-live for these contracts, and we've already taken several important steps towards that, including publishing our contract specifications via market notice in December, as well as announcing our collaboration with Bloomberg via a joint media statement. And we do encourage participants to stay close to the conversation via market engagement and education. So for firms expecting to be early users of these products, it would be great for them to assess the contract specifications, assess whether or not it would fit into their portfolio mandates, and importantly, whether or not it will fit into clearing, trading and risk systems as well. But in the coming months, ASX will definitely be focused on market readiness, providing materials and resources to support education, as well as a lot of engagement that will help us progress towards an exciting launch.
Absolutely. So you definitely recommend that clients start these conversations internally quite quickly.
Definitely.
Great. All right, Marco, Nita, thank you very much. And thank you all for joining us today. If you'd like to find out more about these products, please reach out to us at markets@asx.com.au. Thank you.